Okay, welcome everybody to the panel, the AFA panel 2019 on FinTech and money in the digital age. So we have a very high-level panel here from different continents and also from different fields, from the regulatory side, from China, from the technology side, from computer science, and also from economics. What I want to do is a little bit of some opening remarks, and then every of the panel member will have 15 minutes to do some introduction to the field from a different perspective. We will have a rebuttal, quick rebuttal afterwards, and then we open up to the floor for Q&As. Okay, so that's the plan. What I want to say in my opening remarks, essentially there's a fundamental reshaping going on in the financial system potentially, where payment takes a much more prominent role, so money gets much more interesting. It's not only about banking, credit, payment is much more in the center, because there's a lot of information with payments. All the payments we do, there's a lot of information attached to it, and from that you can do some credit scoring, and knowing your credit scoring, you have a lot of financial inclusion from the payment data, and we will see along Chen will talk about this, how this is already very well advanced in China, and how this will reshape the financial industry, and it can be a tech firm-dominated financial industry. And the digital platforms matter a lot in this, and the credit score coming from the payment system. The second aspect I think I would like to emphasize is there's new forms of money coming up, and the new forms of money are coming out on the public side from the central bank, but also from the private side from real banks. So I worked on this with Dirk Nippelt, where we contrast, the two, what happens if new public money comes in or new private money comes in. And one of this huge, big new money, which might be coming in, is central bank digital currency, or which goes CBDC, where many central banks talk about this. This like everybody can have a bank account with their own central bank, reserves for everyone. The questions are, if you have a bank account with the central bank and not with the private bank anymore, will this actually lead to less lending because the banks don't have the deposits anymore? Will it affect the total economy? These are open questions. You can see under which condition it doesn't and on which condition it does. That's what we have worked on. Other questions are, will bank runs be more likely or less likely? We have a very contrarian view here that we think actually if it's done right, it might actually make bank runs less likely rather than more likely. But these are all new questions which come with this new public money which might be coming. Then we of course have new private money. There's new private money which is in form of inside money, which are debt claims, where you have a claim, you can swap it for official money. Of course, there's Venmo, Zello, Alipay, WeChat Pay. They're like deposits or credit cards in many ways, but also have some differences. And there's some other private monies which are more outside money, where you don't have really any claim, like Bitcoin. You don't have any claim to do anything or swap it into something else. Facebook is thinking of introducing some face coin and so forth. So there are either in form of crypto monies or cryptocurrencies, or they're actually just digital money, so there doesn't need to be a crypto component to it, a blockchain component to it. So the cryptocurrencies are based on this blockchain technology, the distributed ledger technology, instead of a centralized authority. And there's, of course, some studies, and I've worked on this with Joseph Abadi, who is in the room as well, on the blockchain economics. So what are the differences in the blockchain economics? And I would like to spend a few minutes on this blockchain economics. Tomorrow we will present the paper, tomorrow at 10:15 in the morning. So if you're more interested in details, we will go over this again. So essentially, what the big question is, will there be a centralized authority managing a currency or managing a ledger where all the transactions are recorded, or will there be a decentralized ledger where there are many different competing record keepers are possible to write down what was a transaction, what was a valid transaction, what was not a valid transaction, and so forth. And you have this blockchain dilemma. So you essentially would like to have 3 desired features, but you can only have 2 of them. So typically you always would like to have that the recording is done correctly, so there's some correctness. And you can do this in 2 ways. You can do this in one way where it's, okay, we give up on decentralization, we have a centralized authority, but the centralized authority will always correctly record all the transactions like what we have, centralized intermediaries. But in order for the intermediary to be incentivized to do the right thing, you have to give it some franchise value. So it has to have some monopoly power or some power to get some rents in the future. And if it were to cheat, not report correctly on this ledger, but then actually it would forego the franchise value, the future monopoly rents. And because it doesn't want to forego it, it will stay with the correct ledger. So that's essentially one way to ensure, because you don't have to pay any electricity costs like what you have to pay with blockchains, so you have a cost efficiency outcome, but you forego this decentralization or this competition element, because competition would actually destroy the franchise value down the road. So that's the other thing. If you give up cost efficiency and you're willing to go for electricity expenses or other expenses, computational expenses, in order to make sure that people don't mimic pretend to be 1,000 entities and have hence more voting power, so the free entry component, then you can save on these future rents, but you have to then pay on this electricity. So then you would actually go to the other point in the triangle. So you have to pick essentially one side of this triangle. If you want correctness, let's suppose you won't like to have this all the time, then you can either go to a proof of work blockchain, then you have decentralization, but you forego the cost efficiency. You have to pay the electricity costs. If you go for the other component on the other side of the triangle, then you forego the decentralization on the competition, but then you have to pay the electricity cost. Okay, that's essentially the trade-off you're facing. But let me go into this. What is special about a blockchain as a ledger compared to a centralized ledger? As I mentioned before, one is this dynamic incentive scheme where you have this franchise value on future rents, and you have to limit free entry in the future. You have to limit information portability in order to give this monopolist or some future rents such that he's incentivized not to do anything crazy on this ledger. Okay? If you have, on the other hand, a blockchain, your free entry, everybody can become a record keeper or a miner in a blockchain. There's free entry. You need some different elements because there's no continuation value, there's no franchise value, so you don't have a dynamic incentive scheme, you have a static incentive scheme. And for this, you need some features which we call this rollback features. So if, for example, if there's a blockchain, which I depict here in this figure, there's this green blockchain, and then there's an attacker who misreports something on the red blockchain, what's important is that you can roll back. So if somebody, the reward for mining a block, so one of these boxes, mining a block, is you get with a delay, but you really hope that somebody is building on it. But if there's a misreporting, you can actually roll back and fork away from this red one to the green one to the honest miners chain. And this way, you incentivize every miner not to misreport things. So this rollback feature, combined with the ability to fork, is very, very important to keep the incentives aligned, even though you have a static incentive scheme, to keep the incentives aligned to be to have a correct blockchain. Another important component is this forking. This forking, we think, is one of the key things because it leads to way more fierce competition. Why is it much more fierce, the competition? If you fork away from an existing blockchain and say, I would like to propose some different rules, you carry all the information in this new branch of the blockchain. So for example, if there's a monopolist or an intermediary which keeps track of all the transactions, and you would like to propose a different currency or a different blockchain, a different ledger, it is in tradition very difficult to establish a new one because all the information which was on the old ledger is not carried over. But in a blockchain, if you fork away, all the old information is essentially carried over as well. And that makes the competition much more fierce because the information portability is there. And I think this has huge implications down the road, how to design our economy to make sure there's less data monopolies and the information is moving over. And there's, in my view, a big potential for blockchains. Now, another big difference between blockchains and not blockchains is that you can have a very good record-keeping device, but if nobody is enforcing what's on the record, it's pretty useless. So I'll give you an example, and a famous example essentially is a land registry. So let's do a land registry on a blockchain. But let's suppose there's a land registry on a blockchain, but nobody's enforcing that you own the house. The blockchain says you own the house, but you still need the sheriff to kick out the people who squatted the house. So you need some people who kick out people who just possess the house. So it doesn't mean if you own it legally that you can actually live in it. That's essentially very critical. And then the question is, if you have to incentivize some entity anyway to enforce it, perhaps it's easier than to have just a traditional ledger, and because you can incentivize somebody to enforce it and to write the correct things at the same way, simultaneously. Currency is special. So why is currency special? You don't have to enforce anything for a currency, because currency is a bubble. Okay? So you don't get anything from having a currency. The only advantage of a currency is that you can pass it on to somebody else. Okay? So currency is a bubble. The value from possessing it is not like a house that you can live in it, or like a stock where you get dividends, and if nobody enforces that you legally own the stock based on this blockchain, that you also get the dividends if nobody's enforcing that. That's a problem, but for currency it's not a problem, because the only value you get from the currency is that you can pass it on to somebody else. Okay, you don't get any, rent or anything in between, and that makes currency so special, and that's why currency is so prominent in the blockchain space. Of course, there are many, many other dimensions where essentially blockchains are expanding. So let me come back to these overviews, but now in the reverse order, and then introduce each of the speakers. So I mentioned this blockchain economics, this trilemma, the importance of the rollback, this fork competition, the information portability, and the enforcement component. But in terms of the currency, cryptocurrency aspects, so the first speaker will be Arvind Narayanan. He is from Princeton University, he's in the computer science department. He's one of the leading authorities in this space, and he has written probably the leading textbook on this. On Bitcoin and cryptocurrencies. He's teaching a famous online course, so he gives us some overview and introduction on the technical aspects. What is going on? What are the new innovations? Where does he see the whole crypto space going? Then afterwards, David Andolfatto will take over. David is from the St. Louis Fed. He has worked on cryptocurrencies and monetary economics. He has a famous blog on Macromania, probably most of them are familiar with. He will talk about the economic aspects of cryptocurrencies and blockchains more generally. He will talk about the new potential public money on CBDC, what are the implications of that, and give various trade-offs on this. But he's one of the first ones coining the term, I think, Fed coin, has written extensively on many of these aspects. Then we move a little bit more into the financial industry. Jean-Pierre Landau, he's writing a report, or has written a report for the French government. He was commissioned to write a report for the French government how to regulate cryptocurrencies in France. He will talk about the implications for the financial industry. He's in France called the Mr. Bitcoin, nicknamed, and he will tell us different scenarios, how the future industry might look like given the current circumstances and what the potentials are. And finally, will Chen from Luohan Academy, who is at Alibaba and Ant Financial. He was very much at the forefront of introducing Alipay and fine-tuning Alipay, and he will show us what difference Alipay made in China. And in many dimensions, China is ahead of the West. It has way bigger implications already. And to what extent a financial sector which is tech-focused, driven by tech firms, leads focus on payments, the credit scoring they do in China, and to what extent it helps, combined with the digital platforms, to have more financial inclusion, so including people who are not, previously didn't have banking and other credit facilities. Now they can do this, and how this could be a development strategy for many, many developing economies. So I want to go in this order, and we will start with Arvind.
All right. Hello, everyone. Can you hear me? Great. I'm a computer scientist, as Markus said, and this is absolutely my first time at this event. Everything is new to me. For example, people kept telling me they have to go off to a job interview, and I was at first very confused by that, and then my mind was blown to realize that there is a centralized job market in your field. Computer scientists don't have anything like that, nothing comparable. And in fact, as a research topic, we're really interested in trying to build markets and systems more generally that don't require a central point of coordination. And that actually brings us to cryptocurrencies. And so what I'd like to do is to give you kind of an overview of the tech landscape, where things are now and where things might be going in the future. And hopefully that'll be useful to you to kind of set the stage for cryptocurrencies. And by the way, I don't know if you know this, but this week is literally the 10th anniversary of cryptocurrencies. And so let's talk about the first 10 years of cryptocurrencies and what we've learned from them. And I'll give you 3 main points here. And one thing is that I have been surprised, I would say, to find how sound the underlying technology has been. And what do I mean by that? 10 years ago, most people would not have predicted that cryptocurrencies would stick around for 10 years. It would have been quite possible, and in fact it is possible today, that there is a catastrophic software bug in Bitcoin or any one of the other cryptocurrencies that we don't know about, but which could cause the entire system to crash because, for example, it allows somebody to print money for themselves. So that is still possible. So the fact that the engineering has been so reliable is, I would say, a bit of a surprise, and it's, I think, good news that the technology has been pretty sound so far. The cryptography has been pretty sound, and the game theory that goes into cryptocurrencies has also worked really well. And one point I would make here is that, in a certain sense, cryptocurrencies have worked better in practice than they do in theory. What do I mean by this? There have been a number of theoretical weaknesses that have been discovered by researchers in the way that cryptocurrencies work. For example, very recently there was a really interesting draft paper by Eric Bodish at Chicago showing that if you look at what happens in Bitcoin mining, the costs of protecting it are a recurring cost, a flow cost that needs to be paid by the record keepers of the system, whereas the cost of attacking it is a stock. It's a one-time cost, and therefore, if you look at the economics of cryptocurrencies, it sounds like these systems should be much more easy to attack than one would think. And so I think this is an important paper. It tells us something really interesting. I've been responsible for co-authoring a couple of papers about how the incentives in cryptocurrencies can all go haywire. But all of that said, I think the fact that these types of attacks have so far not been observed in practice is good news, and I think we actually need some updates to the way that we model these systems to make our theory, in fact, better model practice. And I think the practical stability of these systems so far is telling us something. So that's my first point about what I think has been interesting about the first 10 years. The second point I'll make is that this one should be obvious, but the development of these things has been a very chaotic process. It's been completely rife with scams of all kinds. Lots of use of cryptocurrencies for various illegal activities, as well as these repeated bubbles and hype cycles we've been seeing. I just wanted to acknowledge that. I think fundamentally that doesn't take away from the value of cryptocurrencies, but I just wanted to put that out there. One other point I'll make is that I think in terms of the adoption story, it's been underwhelming. It's been disappointing. For example, we don't have, as far as I know, any country where people are using cryptocurrencies to buy their coffee. So that use case is not really panned out at all. And I have a draft paper with my team at Princeton doing blockchain analysis, because blockchains are public data, so you can see a record of all of the transactions that have ever been made. And you can analyze it in various ways to try to tease apart the use of cryptocurrencies as a medium of exchange versus other uses like speculation. And our tentative conclusion is that so far, and this shouldn't be really that surprising, that they've mostly been used for speculation so far. Now, that said, I'll come back to the first point on the slide here. One thing I want to point out is that because I think this underlying technology is sound, even if a lot of these use cases have not panned out so far, one point I'll make is that unlike a product issued by a company, let's say, that doesn't find a lot of adoption right away, the company might go out of business. But that is unlikely to happen with cryptocurrencies. I'm fairly confident that they're going to be around 10 years from now, 20 years from now. So over the long run, a lot of researchers, including myself, are optimistic that we're going to be finding better use cases, more useful ways to integrate these systems, these new technologies into our existing systems and into society. So I just wanted to start with that picture of how I see the first decade of cryptocurrency development. One thing I also wanted to mention is a trend that I feel has been happening in the last 2 to 3 years, which is, interlude. I just wanted to point out, and I was talking about the hype a little bit. This is one example. I think the title, the text of that tweet says everything. I don't need to say anything here. This is about banana coins, supposedly the first blockchain option for investing in the production of organic bananas. There are lots of these, bubble things going on, but we've seen a lot of these over the last year or so. But I think things are calming down a little bit. I think the story over the long term, over 10 to 20 years, is much more exciting than these flash in the pan kind of products that are being offered. Anyway, I kind of wanted to break down how I see the landscape today, and I think one thing that's happened over the last few years is a kind of differentiation of the different cryptocurrencies that are out there. There are hundreds of cryptocurrencies, but what has been happening is instead of every cryptocurrency trying to do everything, different cryptocurrencies are trying to provide different types of functions. For example, Bitcoin has pretty much gotten out of the game of even trying to be a medium of exchange. Bitcoin is not considered really to be useful for that today, for doing everyday transactions. Some people would argue that it is a store of value. It's, it's a debatable claim given how volatile it is. However, there are stable coins that really try to be a store of value. Stable coins, if you don't know, are cryptocurrencies, are tokens that try to maintain a peg to the dollar or another currency because there is an entity, an intermediary that is backing the tokens that it issues with actual dollar reserves. So the most well-known stablecoin is Tether. It's been really controversial because the audit statements that the entity issuing it has released have been questionable, so it's not clear if it's actually backed one-to-one by US dollars. Facebook is releasing or is planning to release a cryptocurrency, as Markus mentioned, and that is supposed to be a stablecoin, so that is one interesting area. Now, coming to the second row, a lot of people feel that these blockchain platforms are pretty good as settlement networks. Ripple is explicitly trying to be a settlement network, and some people would argue that Bitcoin is pretty good as a settlement network as well. On the third row, Bitcoin Cash is a cryptocurrency that tries to be useful as a medium of exchange for everyday transactions. And then Lightning Network, this is interesting. The philosophy behind Lightning Network is, let's treat Bitcoin as a settlement network, as an underlying layer, and then let's go ahead and build a layer 2, which is where everyday transactions are going to take place, and it uses Bitcoin as an underlying ledger. And Ethereum, which you've probably heard of, is a pretty exciting development as well in the last few years. I would simply describe it as programmable money. Another term that you might hear is smart contracts. Let me give you one example of something you can do with programmable money, which is kind of a silly example, but I think it really shows why this is something new, something that we haven't really had before. Now, on Ethereum, you can build an honest Ponzi scheme. How does that even make sense? What is an honest Ponzi scheme, and how could you build it on top of programmable money? Well, let's think about this. What's a Ponzi scheme? If I'm running a Ponzi scheme, I might say, you give me $1, I'll hold on to that, and then other people are going to continue to give me money. And when I receive $1.2, I'm going to return that to you, or some fixed return on your investment, and I'm going to continue to keep doing this. Right? Now, everything that I'm promising to do can be specified as a computer program. And you can put that computer program on the blockchain. And that would be an honest Ponzi scheme smart contract. So why is this interesting? Because unlike a regular Ponzi scheme, you don't have the counterparty risk. You don't have the risk that the person running the Ponzi scheme is going to run away with your money. Of course, you still have the risk that you might be the last one to put money into the Ponzi scheme and you're going to lose your money that way. It doesn't avoid that risk, but it does avoid one type of risk, and that is already pretty interesting. And why does it manage to avoid this particular type of risk? Because the money that you put into the honest Ponzi scheme blockchain smart contract is not owned by the creator of the smart contract. They don't have the technical ability to withdraw that money. That money is owned by the smart contract itself. The smart contract itself is an agent, and it can own money, and anybody can look at the code of the smart contract and verify for themselves that there's actually no way to withdraw money out of that smart contract, except according to the Ponzi mechanism, which has been programmed into it. So again, a silly example, but actually hundreds of smart contract honest Ponzi schemes exist today on top of Ethereum, and a lot of people are basically playing these games. But it does show us that it allows you to do something new, which you couldn't really do before. And I think in the long run, there's a good chance that we might find more useful applications to build out of this type of functionality. And in the last row, there are many projects that are building cryptocurrencies to have some special features. One of the more interesting ones is a privacy feature, because blockchains and cryptocurrencies, even though they're quote-unquote anonymous in the sense that you don't need to put in your name in order to interact with the system, at the same time, all of the transactions that you make are going to be publicly and irrevocably and permanently recorded on a blockchain. And so if your identity is ever associated with any one of your transactions, then you kind of lose all of your privacy. And so there are a few projects that are trying to fix this. That leads to a really interesting tension between law enforcement needs and users' privacy desires, which I'll come to in a second. So this is kind of what I see today as the landscape. And then really quickly, what I think are some of the challenges of cryptocurrencies. The first one is security. Here's an interesting story. This was a story of a Bitcoin miner from a few years ago who mined Bitcoins early on, forgot that he had done so, and then when Bitcoin went up in value, he remembered, oh, I have some Bitcoins lying around. He realized it was on an old laptop. That's where he stored his Bitcoin wallet, his private keys, and he had thrown that away. And so the keys to his Bitcoins were now in a landfill, and they were now worth $127 million. He even tried to get the city to let him dig his old laptop out of the landfill. Of course, they didn't let him do it. Here's what's interesting. There are two things interesting about it. It's so easy to lose your cryptocurrencies because it's just a file on your computer. If you get malware on your computer, it can steal all your cryptocurrency. Right, and when we're thinking about issuing other types of digital tokens or assets, stock on the blockchain, or as Markus mentioned, real estate, we're amplifying those problems even. And the second thing that's interesting about it is what happened to those Bitcoins in the landfill. It's not like somebody else took them. Those were lost out of circulation forever. So this money works in very different ways, and we don't have a good handle on it, and we're not good at making these things usable in a secure way for mainstream users. So that, I think, is one big challenge, and that's the first one, security. Second one is, of course, the energy consumption with proof of work. Certain cryptocurrencies are trying to move to proof of stake, but I would say that that's a much more experimental technology, and we don't have the kind of either theoretical or practical guarantees yet for proof of stake, which is a new technology that minimizes energy consumption. Markus, how much time do I have? 2 minutes. Okay, I'll wrap it up in 2 minutes. And then a third one is just handling meaningful transaction volumes. This is still a challenge. It's a pretty inefficient system from a technical perspective. All transactions are broadcast to everybody's computers. People are working on solutions for this, but it's a work in progress. And a fourth one is balancing privacy and law enforcement needs. We still don't have a great answer to this. I'm sure we're going to get into that a bit more on this panel. But right now, it's kind of one or the other. And a fifth one is managing the uncertainty around forks. Because what can happen in a fork is something that Markus talked about. If two groups of miners disagree with each other, they can decide to take the cryptocurrency in two different directions. And the cryptocurrency that originally existed ceases to exist, and two new cryptocurrencies are born. And if you had 1 unit of cryptocurrency A, you're now left with 1 unit of cryptocurrency B and 1 unit of cryptocurrency C. Right? So from a technical perspective, that's pretty straightforward. We know how to handle that. But what does it mean in terms of money? How do we incorporate these types of uncertainty into our financial institutions? We don't really have a good handle on that. Let me end with a couple of quick thoughts on where I think things are going. One thing that I think is going to happen is, today there are hundreds of cryptocurrencies, but we're going to see a lot of consolidation. We're going to start to figure out which ones are worth paying attention to, which ones are bringing something new to the table, and which ones are not. And a second one is, I think we're going to learn something new about the systemic risk that's present in cryptocurrencies. And I would point to especially Ethereum. Ethereum is very interesting in that Ethereum developers take a very experimental approach to putting new features into cryptocurrencies, but that also means that they're taking on a higher risk that something catastrophic will happen from a technical or incentive perspective, and the whole thing will go to zero. So is that sort of thing going to happen in the next few years? Or are we going to be able to learn to build these systems in a way that we can experimentally incorporate new features, but also keep the whole thing running? That is, continue to build a plane while flying it. So that's basically what some cryptocurrency developers are trying to do. And we're going to find out how well that works, I think, in the next few years. And then just one last thing. This one is a little bit like predicting that pigs are not going to fly, but I'll make this prediction anyway. I have been predicting it for the last few years, and some people are surprised every time, which is that I'm predicting that any application of cryptocurrencies that requires mainstream consumers to directly interact with them, to directly interact with the technology using their mobile cryptocurrency wallets or whatever, instead of through an intermediary, for example, some of the intermediaries that we're going to hear about, the former types of applications are just not going to work. We are going to have intermediaries. The revolutionary story around cryptocurrencies that people are going to interact with them in a peer-to-peer fashion, and that it's going to weaken or eliminate the role for intermediaries and financial services. That story doesn't really make much sense to me, and I think that's become quite clear over the first decade of cryptocurrencies. All right, I'll leave you with those thoughts. Thank you very much.
Well, good morning, everyone. It's a great pleasure to be here, and thank you, Markus, for giving me the opportunity to speak on a subject that's been near and dear to my heart for some time now: blockchain, cryptocurrencies, and central bank digital currency. And I'm going to come from it a little bit differently than Arvind. I'm basically an economist, kind of a bird's eye view on what I see is the underlying forces of this endeavor, and then I'll end with a little bit of a sell job for a central bank digital currency. Before I start, I'd like to ask, what do I think these three things have in common? And I think that the common denominator, as far as I'm concerned, is that what this whole endeavor is concerned about fundamentally is database management, or at more primitive level, just accounting. Now, accounting kind of sounds boring at some level, and it kind of is, but it's also tremendously important because it's the type of information we're talking about here. Things like credit histories, credit scores, performance records, things like this. The stuff that kind of constitutes the foundation of reputation, for example, serves as a type of currency. I mean, we can use this information to extract value. And because things like reputation are a form of currency, it suffers from all of the standard problems that you expect currency to suffer from. There's a big incentive to try to counterfeit this information, to try to misrepresent yourself, to various clients or customers or whatever. And so because of this, society has to have in place these mechanisms to try to make sure that this type of information is managed in a secure, accurate, easily accessible manner. So the key question is, how are members of a community, and feel free to define community however you want, a group of friends, a city, a country, the world, whatever. The key question is, how are members of a community wanting to share and manage a database to do so when they do not fully trust each other? That's the key problem. Now, there's any sort of database management system is going to have to specify two key parameters. One is the parameters that describe who gets to read the database. Are we going to make the database open, render it open, say something like a public library where anybody can go and visit the library, take out a book and read the data? Or are we going to delegate the responsibility to a trusted third party, say like a bank, to keep our private information on our accounts private? And the second dimension is even more importantly, is the right privilege or the right permission. Who gets to write to the database? Because remember, this data is like currency. And so the power to write to the database is analogous to the power of printing money. And whoever has the power to print money has a lot of power. So are we going to, again, delegate the responsibility of writing to the data to a trusted historian, or are we going to consider a more community-oriented, kind of consensus-based mechanism where the community together tries to come up with an agreement on what the shared history of the community is. So in terms of a picture, I think we can graph these parameters. On the y-axis, I have a parameter describing the openness of the read privilege, to more open to less open. And on the x-axis, the parameter for the write privilege, whether it's more open or less open. And then we can fill in the quadrants here with various examples. What is an example of an open database where the write privilege is closed? Well, a public library, like I mentioned before. You can go to the library, read the database, but it's not like I can take my own book and store it in the library. The librarians act as the gatekeepers. They're the ones with the permission to actually add to the database. In terms of a database that's where the read privilege is closed along with the write privilege, we'll just think of your bank account, for example. What about an example of where the write privilege is open, more or less, and the read privilege is kind of limited? And here, actually the only example I can think of right now is like the peer-to-peer cash transfer system. The ledger in this context would be the ledger, say in this room, for example. Everybody in this room probably has some amount of physical cash in their pockets. It's distributed in some manner in this room, but this ledger is largely invisible to us. So the read privilege is essentially absent. But the write privilege to the ledger is open. Any one of us can effect a peer-to-peer cash transfer and alter the structure of the ledger without the use of any intermediary. And then finally, in the top right-hand corner, we have kind of this new emergent technology, the cryptocurrencies, where the read privilege is largely open. Take Bitcoin, for example. The blockchain is open. It's visible to anybody who wants to go look at it. And the write privilege is also open. Note that also in the top right-hand corner, I include another large class of database management systems that are very, very ancient in form. And they share a lot of the properties that these modern cryptocurrencies do in the sense that they build on open ledgers that are updated through some communal record-keeping process. So, think about reciprocal gift exchange and hunter-gatherer societies or just any sort of social credit system in small groups today in society. What's happening in the small group is largely common knowledge. It is communicated through gossip. So the ledger of past actions of members of a community are basically open access, and everybody gets a chance to add to the shared history of the community, and somehow the community has to come to some agreement as to what constitutes the shared history. So, what problem does blockchain solve? Well, before answering this question, I like to define the term first. What do we mean by blockchain? And to me, a blockchain is a database that's organized by some Merkle tree structure that is updated via what is hopefully a strategy-proof communal consensus protocol or game. If this is not part of your definition of blockchain, then I don't know what you're talking about. I mean, you might be talking about something that's really fabulous, but it might be some innovation in database management, but it's not blockchain unless it has these properties, at least as far as I'm concerned. Consider a database management system that has these properties that constitutes the blockchain. What's it good for? Well, I can think of some examples. Hypothetically, I think that it might be good for database management when a delegated record keeper is either not trusted. So, think about these large companies that are accumulating and managing large stores of private data that are subject to these private data breaches, like Yahoo recently and Equifax. Or there might be a constituency out there that just has a fundamental distrust of large firms or banks, and central banks in particular. Fine. Or it could be that it's not that you don't trust the entity, it could be just that the entity has a monopoly position that it's exploiting and it's too expensive. So I can think of perhaps, if you're thinking about in terms of international remittances and the role that Western Union plays in that. They charge very, very high fees for international remittances, and maybe you want some mechanism to bypass that sort of transfer of information. And then finally, it might just be that the trusted record keeper is absent in some way. You know, think about you're a firm belonging in a community of firms along a supply chain. You wish that there was some sort of centralized database that a trusted record keeper could manage on the behalf of the members of this supply chain, but this entity is absent. What do you do? Kind of a blockchain might be some sort of database management system that might serve as a substitute in this case. What are the successful use cases? Here I kind of reiterate what Arvind has said. I don't really know, though in fairness, it's still early. We do have the examples of cryptocurrencies. I don't consider these necessarily to be successful use cases to date. They may be in the future. For now, they're successful proof of concept, I would say. At the end of the day, I think it's really tough to beat a trusted, reputable intermediary in terms of information efficiency, I think, when it comes to database management. And, you know, if you want to, for example, compare Bitcoin to, say, FedWire. FedWire is the real-time gross settlement system that the Fed operates for depository institutions in the United States. There's literally trillions of dollars are moved every day on FedWire. Fast, cheap, secure, instantaneously, and it runs at basically zero cost. Contrast that with Bitcoin that doesn't scale very well and is also very, very costly, and of course intentionally made to be costly. You know, you may still desire a Bitcoin system if you don't have the trust in the Fed to manage the payment system effectively. But you know, why would you not trust the Fed is what I say. And I'm not saying that just because I work at the Fed, but literally, it's not like the Fed's going to steal your money. How do we know that? We know that because the Fed can print all the money it wants on its own. It doesn't have to steal it from you. So. It's a proven, you know, trusted, very efficient, low-cost system. Now, it may be the case that you and I don't have access to it, and that's true. Only the big banks do, but that's a separate concept. I mean, the answer to that is not necessarily turn to Bitcoin. The answer to that is let's promote a system that grants more universal access to a FedWire-like facility for everybody. And I'll talk about that in a moment when I talk about central bank digital currency. As for the cryptocurrencies themselves, you know, these are basically decentralized autonomous organizations made possible via blockchain technology. If you don't know what a DAO is, Google it. It's going to be something that people are going to be talking about more and more, I think, in the future. The cryptocurrencies, I think, are a really cool idea. I always thought it was really amazing. I'm often asked as a central banker, how do I feel about this emergent potential competition of cryptocurrencies with the US dollar or other currencies? Am I worried about it, or is it going to take over banking or make central banks redundant? I'm not terribly worried about it. You know, central banks have a lot of experience dealing with currency competition, and I think the central bankers and policymakers, at least to a first order approximation, the way we should treat cryptocurrencies is that it's just another type of foreign currency. It's just not issued by a foreign government, it's issued by some private entity. The monetary policy exists as computer code, it's completely transparent, but it's de facto just a foreign currency. It's no big deal in that sense. In terms of where do I think all of these cryptocurrencies are going in the future, do I think they're going to disappear? I think I agree with Arvind. I think you'll see a lot of consolidation, but I don't see them going away. I mean, we have a long history of the coexistence of private monies. There are thousands of privately issued paper currencies in the United States presently. These things might be displaced by their electronic counterparts, but I could see the coexistence with, you know, each type of cryptocurrency satisfies a particular niche market. What about the idea of a central bank cryptocurrency based on blockchain technology powered by, a central bank cryptocurrency based on blockchain technology? I've heard this idea promoted every once in a while, and I literally think it makes no sense. It makes no sense whatsoever to have this type of database management managed by a costly and intentionally costly consensus-based, you know, gamed consensus protocol. FedWire, I mean, accounting is not rocket science at a basic level. It's just debiting and crediting accounts. And if you do have a trusted entity, a trusted accountant to do the accounting properly, you don't need this cumbersome and costly kind of consensus-based blockchain technology to facilitate the information management. So if I don't believe in this kind of Fed type of cryptocurrency, what do I promote? I promote this idea of central bank digital currency, but not based on blockchain, just something else. What do I mean? Well, we already have digital currency in our economy, right? Through private banks or private bank deposit liabilities constitute private money already. And certainly it's a case that private banks have digital reserves via the central bank. What I mean by central bank digital currency is simply that we're going to grant access, open access to central bank accounts, say in the United States to all US persons, for example. And why not? Because presently the Fed already permits open access to its balance sheet in paper form. Anyone in the world is permitted to own a piece of the Fed, and you do so whenever you hold a paper US dollar. Why not? And it seems to work pretty well. If it works so well with paper, why not extend it to the electronic counterpart, which is potentially interest-bearing? So what I have in mind here is some combination of FedWire with TreasuryDirect.gov. So FedWire, a very efficient, real-time gross settlement system, combined with, I don't know how many people have heard of Treasury Direct, but you go to that website, and the U.S. government, the U.S. Treasury permits any U.S. person to open an online account with the U.S. Treasury, and you have interest-bearing Treasury accounts. Now, the system isn't set up to help you make payments, but that's a detail. I mean, why doesn't it let you make payments using your balances in your Treasury account? If you did, you'd have something very close to central bank digital currency. And to me, it makes a lot of sense. Why? Well, why not? Why should only banks have the privilege of virtually zero-cost real-time gross settlement with the Fed, and the accounts earn a high interest rate, right? Relatively high, 2.4%, fully insured. Why is it that private individuals like you and me, say the small firms operating on very thin profit margins, have to rely on this cumbersome ACH system? They pay high interchange fees. You know, there's many, the U.S. also has this kind of problem with many people are unbanked, for example. The banks themselves don't seem to pass on the interest rate increases they're enjoying to the customers. Here I've plotted various lending and deposit rates in the United States. You see that since liftoff, since the Fed started raising interest rates in late 2015, that blue line is the effective federal funds rate. That's the interest that the banks are earning on their really nice deposits with the Fed. And you see the lending rates are going up. The lending on business prime rate or the home equity line of credit rate, they're all rising. But the bottom two lines are flatlining. They're basically deposit rates. Depositors aren't benefiting. So what are the economic consequences of this? How much time? 1 minute? Okay, so I'm going to have to steal Jean-Pierre's minute. He stole about 5 minutes from me last month in Paris, so I feel like... I told you it'd come back to bite you, so I'll go very quickly. I have 2 slides left. You know, there's a question. What would be the economic consequences of introducing an interest-bearing central bank digital currency? I don't have time to go into details here. I wrote a paper on it, and it's available at that link. I wrote down a monetary model, where the monetary policy is governed by an interest rate rule, and there's a kind of a Klein-Monte monopoly bank that inhabits this model. So I modeled the monopoly power of the bank very explicitly. And this monopoly bank can deposit or borrow reserves at the interest on reserve rate at the central bank. The central bank issues an interest-bearing central bank digital currency, and the monopoly bank maximizes profits given the monetary policy. And the model also, I think, realistically is populated with people who are different. We have rich people, poor people, and people face a fixed cost of accessing the banking sector. So endogenously, I have people in my model. Some choose to become unbanked. That is to say, they rely on cash to facilitate their payments, and others choose kind of to bear the fixed costs and access the banking system where they have the benefit of this insured, real-time, interest-bearing account. What are the results I find? Here are the key results. The introduction of this interest-bearing central bank digital currency has no effect on bank lending operations. So, I mean, if you think the central bank digital currency is going to disintermediate banks in their lending operations, you have to think twice. You have to really think carefully about what is the mechanism you have in mind. Because I'll go, the logic is there in the paper. The opportunity cost of funds here is the interest on reserves to the banks. And if that doesn't change, there's no reason for why banks should be disintermediated in their lending operations. The effect, however, is to force banks to increase their deposit rates on us in order to kind of keep deposits at the bank, because they make a spread on the deposits. The interest on reserves net of the deposit rate is the profit they make. And so essentially the effect in my model at least is to compel banks to become more competitive, to offer depositors more attractive terms. In the paper, this is solely in the form of an interest rate. In reality, it would be many services along many other dimensions. And it could indeed serve to increase the depositor base of the banking system, so encourage intermediation, contrary to discouraging it. It will, of course, lower bank profits, monopoly profit, and that may be good or bad depending on your point of view. And the model is actually kind of good. It encourages financial inclusion. It makes holding interest-bearing accounts more attractive to poor people. They're more willing to access the banking system. So there's a reduction in the demand for cash. And finally, in terms of what the implications are for financial stability, a lot of people have opined back and forth about whether the central bank digital currency will encourage stability or lead to more instability. In my model suggests that there's absolutely no reason to expect this instrument to have an effect on bank stability one way or the other, because at the end of the day, we're just introducing another interest-bearing government security into the world. And why would you expect that to contribute in any meaningful way to, say, stability of the financial system? Thank you very much.
Thank you very much, Markus, for the opportunity to talk in front of such a distinguished audience. I have some friends there. I've called that a futurology, and it could be even more like a science fiction exercise. You know. I'm an avid reader of science fiction, and I think it's very helpful when you go through periods of transformational change, which I think is what we have now in finance and money. And I would like to explore one possibility, one question, and the question is whether we will shift from a credit bank dominating financial system to a payment dominated financial system, where the payments will take over from credit as the core financial function. Now, I'm a little bit nervous of talking about that before Mr. Chen, because he's the one who really knows about it, but that gives him an opportunity to correct my mistakes, and I'm sure that there will be many. So if we look at what technology is doing, I think we have basically two basic trends, two very important trends which will affect what we are going to talk about. The first one is a sort of resurgence of what we call token-based money. Now, token-based money has been very aptly defined by Professor Charles Kahn as payment instruments which can be authenticated by themselves, by their content, as opposed to account-based money, where you have to authentify by the owner, so you have to have a proof of identity, and actually when you make a transfer, you have to have two bank accounts and two identities. So, building on what David said, if we have a token system with us, we could exchange times of, 5 minutes of speech versus 5 minutes of speech. I would need to know his identity. I would need to know his banking ID. We just would have a computer which would store tokens, and we would exchange tokens over time. And that's what tokens allow. So tokens are very appropriate to peer-to-peer transaction. And the second, of course, evolution is the emergence of big networks, social network, commerce network, which can act as payment networks. And payment networks which can have as social networks. So the big payment networks in China, for instance, the biggest one, has emerged from a message system, that's the Tencent. So when you put the two together, I mean, it's very intuitive to think that we will have an aspiration to directly exchange value in the cyberspace with people who may be very far away from us and whose identity we don't know. That's the aspiration that we all have. We are able to send email messages across the world in 1 minute. Why can't we send $100 across the world in 1 minute? That's what we're talking about. And those two innovation, I mean, that give rise to, of course, what I call, because I'm a former central banker, I didn't call that a monetary innovation, a monetary experiment. And of course, if you combine them with what Arvind was talking about, the cryptography, the consensus rule, and the distributed ledger technology that Markus explained, then you have the cryptocurrencies. But what I'm going to look at is the second part, is the impact on the architecture of the financial system. So I do have a point. Sorry. So this I said. So this is a stylistic representation of what we have now. So we have the banks, and the bank have, they give credit, they take deposits, and this is through this credit and deposit relationship that the bank know their customers, they have the relationship with their customers, and that's how they get the data. And the payment function is a sort of, it's a very important function, of course, banks would not exist with payment, but it's a logistical function. It's there to help the other functions to work. And the card companies, sometimes, they do not know the customers. They don't have a direct relationship with the customers. And I must confess, maybe people will know, I don't know what kind of data they have about individual transactions or not. But they are here, they are very powerful, they are very big networks, but they are here as support and logistical function. The system I'm thinking of does not really exist, but the system I'm thinking of is different. At the center and at the top of it, you have a social payment network. And that social payment networks, of course, it's presented here typically as acting as a two-sided market. You have on the one hand the apps, the e-commerce application, and on the other hand you have the customers. And you will know that the customers can have direct relationship between them through the payment network without needing to ask to order for a merchant or to order an app. So it acts as a payment system, as a messaging system, and as a two-sided market. And in that system, of course, the bank is there. You cannot dispense of having an account. You cannot dispense of having a monetary relation balance sheet somewhere. But it's there as a sort of subsidiary, you know, a kind of technical subsidiary. You have a balance sheet there, which records some accounts. We will see what kind of accounts it can remember. But it's not where the relationship with the consumer is. It's not when the main function is. And so it puts the payment and its externalities and the network, its externalities, at the center of the financial system. Again, at this stage, it's partially a dream, maybe partially a dream, I don't know. But I just want to think about whether this is something which the two technological evolution that I mentioned will bring about or not. So what could trigger the evolution? I will discuss three big possible dynamics. The first one is that the business, the operator of those big social and e-commerce networks decided in the interest from the business point of view. The second is a technical competition between cards and mobile, and I think this is going to be very interesting in the future. And finally, the strategic decision by those networks to run or not what I would call a monetary balance sheet. So let's discuss one and the other. Social business model of the networks. Increasingly, they show themselves as potential aggregators of commerce, payments, and data. And by the way, in the graphs I showed, the data was absent. It was a big mistake. I will correct that. So there are externalities and complementarities in payment and e-commerce networks. Networks have the data. They have the data. They have several hundred of millions of customers. I checked this morning. PayPal has 250 million. Alipay has 600 million, Tencent has 700 million. I checked Bank America, 50 million customers, which is already enormous, but the numbers are extremely, in an order of magnitude, very different. And what is very interesting too, if you look, for instance, at Apple Pay has doubled or tripled its number of customers in a matter of 2-3 years. So we are talking of something which is really happening right now. And if I can make an aside remark, when you read the literature on e-money, it all goes back to a time where e-money was prepaid card. The mobile is totally absent from the literature on e-money. And as I showed in my first graph, the mobile is what actually empowers all those technology to come to fruition and to influence the architecture of the monetary and financial system. So we may have to revise, and when you see the numbers, the growth numbers that I mentioned, we may have to revise all our approach to e-money and think about e-money as being essentially mobile money, not prepaid card, not something like that. And so we can have a dissociation of credit and payments again becoming the core activity. Mobile versus credit card, very interesting. Both mobile and credit card today have a near-field communication capability, so they are equivalent from that point of view. Mobile allows for peer-to-peer payment, no terminal. So, correct me if I'm wrong, but if I want to pay my taxi in Beijing, I can just send on this mobile. We don't need another terminal, so that's a big advantage. And mobile allows, but not impose, to dispense of a bank account. So the big question, and I'll come back in a minute, whether mobile money will be attached or not to a specific bank account for each customers. That is a very big question for the future, which in my view will determine a lot of what the financial system will look for. And of course, potential growth of e-money, which I mentioned. So the first thing is whether the future operators of payment system will want or not to run a monetary balance sheet. So you have two models which are possible. The first one on the left, which is actually, I think, the one adopted currently by the Chinese wallets and payment service provider. Each customer still keep their bank account, but the payment service provider has access to their bank account, and through the apps, they move money through the bank accounts according to the instructions of the customer. That's what we have. That's what the European Commission is trying to do in Europe with its Payment Service Directive, and that's what exists right now. So the big advantage, of course, for the payment service provider is that they don't run a monetary balance sheet. This is the Chinese-European model. And on the right, we have what I would call a true e-money model. So you have the e-money issuer. The e-money issuer has, of course, a bank account. You cannot dispense at the end of the day of something like a bank in the system. But each customer does not have a bank account. This is the M-Pesa model in Kenya. And one big mystery for me, why hasn't it generalized? So that's one big question about the future of this architecture. But you can run, I have friends who live in Kenya, they run their company, they have small businesses. They're all their small businesses without a bank account. So the big question for banks, in my view, is how far we will move from the left-hand side to the right-hand side of the scheme, and what will be the role of the banks and the payments in the future architecture. Two scenarios. First scenario, the bank adjust and compete, and I think it's maybe the most likely scenario. They are getting better and better retail payments, getting better and better scoring, and most likely the current benevolence that e-money issuer benefit from regulators in the name of competition might not last. And also, as I said, non-banks may hesitate to run a monetary balance sheet. So there's a lot of reasons why banks could still retain their leadership. Another scenario is the scenario of the preeminence of payments. Payment networks become developed and encompassing ecosystems. That's what the Chinese payments networks are doing now. They may, I don't have time to develop, maybe we can discuss that during the debate, they may have their own currency, either a form of token which is not interoperable with other networks. That's already, even if it's denominated in your own unit of account, it's already your currency. And I understand that the tokens and Tencent and Alipay are not interoperable in China. Are they? No, so they are not. So these are networks who are developing somehow their own currency, even if both are denominated in renminbi. Very important, very important. They have the data, they do the scoring. There is a question of whether they will be interoperable or not. And in my view, for the regulators, this is one of the major questions in the future. Consumer, I don't know your kids. Maybe your kids won't want to be bothered by opening an account anymore. So if they don't want to be bothered by opening an account, the social pressure will be moving to the right-hand side of the graph. And credit and deposit taking become accessory. They become kind of logistical function which come up. The main driver are social habits, the competition between cards and mobile and payments. I talked about it. The technology, new app of smartphone, and the regulators. So that concludes my presentation. And I think a lot will depend actually on the strategic choices which will be made by those big networks, and maybe that's a good transition for the next presentation.
Okay, thank you very much, Markus, for inviting me. And you can tell that I'm not in the academic anymore because my slides have colors. So I'm happy to be the last one to talk about it because it's more has payment and other aspects of finance. So since we're in the finance industry, sometimes we have to ask ourselves, what are the major challenges in finance? And if you ask me, I think there are at least two of them. The first one is that I call this the typical 20/80 rule. So basically, the majority of the companies and the users in the world do not have adequate financial services. Globally, there are still 2 billion people who do not have bank account, and only 10% of the people in emerging markets have credit cards. So essentially, the majority of the people do not, and the companies do not have financial service. That's the first problem. The second problem is that even among the areas or the people who do enjoy financial services, finance tends to have its own life, so it doesn't quite focus on the real economy. We spend too much time, I think, to try to predict the stock price of Apple and Google, but very little time to think about how finance can serve most of the people in the world. So what I'm trying to say is that finance, so these are two problems, I think, in finance. It doesn't serve most of the people or companies, and it tends to think too much about itself rather than think about how can I serve the real economy well. I think those are the two problems. And reflecting this on the academic, and I was academic for a long time, so after graduate I realized that if a profession think too much on no arbitrage and a risk and return trade-off, there's something wrong with this profession, because in essence, finance is a service, if you think about this. So the right trade-off should be, how should I provide the best service to most of the people, which is the sustainable, affordable, and versus the risk and the expense. So that's the right trade-off, but not about how to make money and what's the risk and return trade-off. So that's something wrong, and reflecting that, you can think about that the best of a lot of the brilliant finance professors, after they quit finance, unless they go to the funds to try to make money, there's nothing else they can do, because we have never learned how to use finance as a service. Okay, so I think those are the problems. Now, what's different right now, I think, is that in the digital age, there's something really happened. And there are two special features. The first feature is that digital technology has very low user threshold. And there's a lot of numbers. And essentially, digital technology has unprecedented speed of adoption. If you look at worldwide, there are more than actually 4 billion people have access to internet right now. In the emerging markets, even among the poorest people, about 70% of them already have the mobile phones. So digital technology has very low user threshold. That's one thing. The second special feature is that the information, the digitized information, it has close to zero marginal cost and is non-rival. Sometimes we say that data is oil, but it's actually not oil, because oil can only burn once, but data can be used unlimited times. And I think those two features have profound implications for finance. So how does it change finance? Well, if you think about finance as a service, essentially you have to ask, how do I get to my customers to get them to use the service, accessibility. Then also, how should I assess risk? And both of them are being fundamentally changed by the two features I just talked about. So the mobile internet and the Internet of Things is fundamentally changing the way we get access to finance. So that's the first thing. The second is the big data. Now, the big data, actually, it means that it's so much easier to get the digitized information. We have a lot of digital footprint. So you do not just go to each customer to check their credit, check their credit risk anymore. You actually have a lot of the digitized information. You can use that at almost close to zero cost. So the big data plus the cloud computing, which is the talk about the efficiency of the assessing the big data, and AI, artificial intelligence, further improve our efficiency of the big data using the big data. So those together, big data, cloud computing, and AI fundamentally changed how we get the big data and the assess risk. Then that plus the accessibility that changed the, I think, the foundation of finance, and I'm not even mentioning the blockchain here. So those are the logic. That means the technological infrastructure of finance is being changed, and that will make change the business model and change how finance is getting accessible around the world. And this is already happening. So I'm using the China as the example. You can see now actually the adoption of the digital technology is not determined by the level of the economic development. If you look at China, China actually only have the average per capita GDP, but you can see China right now it has 1.25 billion internet users, and China we know that China's economy has become the number 2 in the world in aggregate, but and the fact that is underappreciated is that China has become the leader in e-commerce. Right now, e-commerce accounts for about 23% of its retails in China, which means China's economy is not only more and more becomes consumption-driven, it's actually more and more online consumption-driven. So that's on the e-commerce side. On the payment side, back in 2011, actually China has a mobile payment about 15 billion, and the United States is 8 billion. And right now, I checked, I think China has the several trillion of the mobile payment, which is like hundreds times of that of the United States. So what I'm trying to say is that because of the low user threshold of the special features of the digital technology, actually it becomes much more accessible, and that can change within several years. So, and nowadays actually, I was just talking about the payment becomes so much more accessible. It's not just about it's not only so much more accessible, it's also actually safer. It is actually much safer than the plastic credit card nowadays. Just in comparison, in China, the fraud loss rate for payment for the bank cards is about 2 basis points. But if you look at Alipay's the fraud loss rate for payment, it's lower than 0.01 basis points. So it's like 2 scale safer. And the reason is easy to understand. If you think about nowadays, actually, if you have using your mobile phone to do the payment, we know precisely who actually owns the account. Is this the right person to make the payment? Does this person have enough money in the account? Is that under the normal circumstances actually this guy is making the decision? So we have so much more dimensions of information than just in swiping this credit card. You have no idea who is swiping this. Is it a dog or person, right? So you can see that you have so much more information. That's why it becomes much safer nowadays. And it's not just much more, it becomes much more accessible and safer. It also becomes much more affordable. In the United States, we know that, for example, if you use the credit card, I think the merchants are still charged around 2% of the fee, and in China it's about only 0.6%, one scale lower. If you look at P2P transfer in the US, it still charges more than 1%, and in China, essentially it's free. So essentially, what I'm trying to say is that in the past 10 years, payment has gone through a tremendous change. It becomes so much more accessible, safer, and affordable because of the digital technology. And because of that, it's not only just online, actually becomes the offline. In a lot of use cases, people are using it. And talking about changing the industry, I'm giving you this. You can see that this old gentleman, actually, he's begging for money for the digital money. So you can use the QR code to pay him the money. Okay, so it's not just about payment actually, because of you have the digitized identity of the information. Now, I think for the first time in the human history, actually, it's a lot of the startups, they can enjoy the no collateral SME financing. So we know that if you're using the bank model, essentially at least 80% of the loans to SMEs have the collaterals. But you can, and on Alibaba's platform, there's about 10 million SMEs. Startups, and the majority of them enjoys the no collateral SME financing, and they have this. We have this something called a 310 model. It takes 3 minutes to apply and 1 second to get money, and zero manual interference. You can see that because you have the digitized information, and that can be used in many different use cases. So the way we assess risk, the way we can give financing is being changed. Let me give you a final example of how innovative that FinTech can do. This is the interesting example. Actually, we came up with this product. Actually, I remember as 2.5 years ago in my office. Actually, at that time, we were trying to come up with a product that can help people to promote green finance. We know that green finance is usually only the governments and big institutions talk about it. The average people can complain about it, especially in China. We actually can see it, we smell it, of the pollution, but we want to do something about it. But the question is how. So we came up with this idea that actually we can use the mobile payment and the digital and the big data to track consumers' carbon footage upon their approval. So for example, let's say Markus decided to be a better person, and so instead of driving to work, he decided to take subway. So there's a reduction of the carbon consumption that will actually be translated into this little green ball, into his Alipay account. So he can collect that little green ball. So there's a little virtual tree will grow in that in his Alipay account. And actually, if he doesn't collect the little green ball, and his friends can steal it from him. So it's only in this particular interface, just for the game. So that creates the peer pressure and fun. And actually, so this little tree will grow when you watch your green behavior. So when this tree grow to maturity, actually a real tree will be planted in the deserted areas. So and actually you can track your tree where you plant it. You can see using your China version of the Google map. You can drive there to see how your tree is being grown. And so after it's launched, within a bit more than 1 year, more than 300 million people have opened this service. It becomes the largest personal carbon account in the world. So essentially, you can think about actually more than 3% of the population on the planet, actually they watch their green behavior and they are planting trees every day. Okay, so, but lastly, I'm talking about the advantage of using the big data, digitized information to do finance, inclusive finance. But let me mention a little bit about the privacy issues. So I think there are obviously issues, but the technology brings the problems, but it can also bring the solutions. What this graph shows here is that actually, if you have the proper practical and with the technology, you can have a reasonable privacy protection. Basically, when you acquire the data, it should be authorized, and after it is authorized, before anybody can use it. I think previous speakers talked about something about it. Before anybody can use it, the data can be desensitized and encrypted before anybody inside can analyze the data. And also nowadays, when you are using the data as technology, something like the secure multiple party computation skills, such that you can actually work with other parties with the data to have the insight, but without actually exchanging the data itself. You cannot trace back the data. So there's a lot of ways that can provide proper protection, such that it can give you the effect that as if it understands you, but who doesn't know who you are. Okay, so I think that's the basis in the big data age. We have to use the big data because it has tremendous benefits, but you want to have the proper privacy protection. And I think it's possible with the proper arrangement. My time is up. Thank you very much. I'm stealing a minute from Markus. So I have a couple of slides I want to talk about. I think the future of finance, because that my previous speaker talked about. I think one direction, as we can see, is very clear, is that finance being more and more merged with the real economy, which was one of the biggest challenge in human history. And it's easy to understand because nowadays actually again, digitized information can be used many, many times. So actually, when you're merging with real economy, you serve real economy better. Also in the meantime, it can give you the real-time risk assessment. Okay, so that works both ways, becomes a positive loop. So it becomes merged more and more with real economy, and also it becomes much more customer-centric. Okay, so in the future, I agree that it's not a particular financial institution based, it's more at the user-centric, and we can call this universal finance. So there's a lot of coordination between a lot of the financial services working together. So I think I have this stop here. And anyway, so that's we actually wrote a report. So right now I'm working for this is called Luohan Academy, and we just wrote a report on the relation between digital technology and inclusive growth. It will be launched later this month in Davos. Actually, we're working with a lot of the top scholars, including Markus. Actually is also a participant. So anyway, I think I have to stop here. Thank you very much.
Thanks a lot to all of you, and let's now open up to the floor. I don't think we should go back to a rebuttal phase. Are there any questions?
Thank you for the outstanding sharing, I guess. I myself learned a lot. I have a question for our friend from St. Louis Fed. Of course, other panelists are welcome to share their remark. My question is about the central bank digital currencies. I believe that not too long ago in Shenzhen, I discussed a paper related to that field. I think China, the Bank of China, People's Bank of China is pushing very hard about central bank digital currencies. My question is very simple. Central banks supposed to do monetary policy, economic growth, unemployment, inflation, whatever. And suddenly now, central banks say, I'm going to compete with commercial bank by going into digital currencies. If I'm the commercial bank, I will have a strong feeling about it, okay, first of all. By the way, we do need commercial bank to help a lot of transactions. And I think you show that the lending activity of commercial bank actually won't be affected that much because the interest rate may go up and da-da-da. However, commercial bank, they need to get deposits, like the other speaker mentioned. They need to attract deposits so that they could lend. If they increase the interest rate, therefore, the deposit probably will go down. That means they could lend less in the future. That may not be good for the whole economy. So please share some comment why central bank would want to compete with commercial bank. Are we going to see commercial bank disappear pretty soon? Thank you.
So those are excellent questions. No, I don't think. Why do I believe there's a role for a central bank or some public agency like that? The vision that I and others share is it's kind of like a basic minimum public utility sort of payment system, safe, secure accounts, very much the way actually in many countries have postal savings. The United States itself had a very successful postal savings bank from about 1913 to 1965 that basically fell out of favor, I guess, once the federal deposit insurance was introduced, but it was very successful, very popular government-insured accounts before deposit insurance was there. So what we have in mind is just a basic level, kind of utility level of banking service to reach those presently that are unbanked or have difficulty getting access to banking services, and also perhaps whittling away a little bit at the excessive monopoly power of the incumbent banks. In terms of what I think, your statement that the banks need deposits to make loans, I think is wrong, wrong-headed. I mean, banks create deposit liabilities in the act of lending. And in my slides, I was actually careful also to say that a lot of what the predicted impacts of this new instrument would depend a lot on the regulatory structure. Now, in my model, I made a pretty extreme assumption that I admit is a little bit perhaps unrealistic, but in principle, it's just a matter of policy. The assumption was that banks, if they wanted to, could go borrow reserves directly from the central bank at the prevailing interest rate. And if they can borrow reserves at the interest rate, they don't need deposits. They can still finance and fund and create demand deposit liabilities, or they're subsequently redeemed and perhaps transferred into the central bank digital currency. But it need not impact on their lending operations. Their profit margins are not affected in their lending operations. The profit margin on managing the deposit and payments is affected, but so the model makes very clear that these things are conceptually distinct. They could be tied together through some sort of regulatory, structure. That's true, and for any realistic proposals of this institution would have to take these into account. But in principle, I don't think what you said is correct.
Okay, I think Jean-Pierre wants to react for 1 second, or
1 second,
and then we go to the next question.
Yeah, I fully support and agree with, of course, with what David said. And I would add one thing. It's no coincidence because if China is pushing for a digital currency. And the reason is, and has been explained, cash is disappearing in China. And cash is the only public money that we have in our hands. All the rest, which has bond deposits, are claims on private entities. Of course, as Markus said at the beginning, those claims on private entities are convertible into public money. But if there's no public money, you have to ask yourself, what are they convertible into? And so it's basically a system where we would not have a citizen access to any form of public money would be a dramatic change over the past 3 or 4 or 5 centuries. It would be a totally new world. So I think the main responsibility of the central bank, even before monetary policy, is to provide us with what used to be called in the US uniform currency. And the uniform currency means some kind of public currency available to people. If it's not available in cash, it has to be available in electronic form. And that's, I think, the case was. I would very much support what David said.
Can I just jump in? I have to jump in. I'm so sorry. Because it's a burning issue. I think we're confusing money, cash, and legal tender, because we are missing the term. Legal tender, money, no matter who you are, we have to accept it. One of the speakers talked about Bitcoin. No, I could refuse Bitcoins, but I must accept money because they're legal currency. In China, last week, they just announced some people at the airport, they refused to accept renminbi, legal tender. So now central bank in China said, no, you must accept legal tender, cash. So we will still have the cash economy no matter what we like it or not. Sorry, I'm Jackie So from University of Macau, commercial town. Go to casino, that is money. Thank you.
Okay, let's come to the next question.
I have a question for Dr. Chen. Just before you ran out of time, it looked like you were going to make some very interesting points. So what were you going to say at the end?
Sorry, I missed the question. So you're giving me a chance to talk about what I skipped? Yes. Okay, so I think this, oh my God, that's just great. So basically, I think it's one slide I skipped, and I think it's very exciting. I think in the next 10 years or so, there's something will happen. One thing is that for pretty much all the companies, I think the SMEs, most of the SMEs, at least in China, I think that will happen in a lot of emerging markets. They will have their CFOs. So up to now, we know that the small companies, they don't have CFOs. They have a bank. They have accountant, can do the account right, but they don't have CFO to manage a lot of stuff. But I think every company will actually have a smart CFO. so through your phone or this or that. And also everybody will actually have something called I call this FinLife. So it starts with the FinTech, but actually you have financial life. Actually, you're going to have your own smart CFO. So everybody actually a consumer. You're going to have the, it's like a assistant, smart assistant, tell you how to manage your money, how to spend, how to earn money, etc. So I think that is happening quickly. We can see that within the next 10 years. So as this really exciting future, that's happening. Yeah.
Are there any questions? It's unusually silent. Otherwise, I throw some question in. Perhaps, Arvind, you can speculate a little bit more on the technology front. Oh, yes.
Hi. I found the point in the last presentation really interesting, and it said that what Alibaba does is basically you collect a lot of data, you understand, basically the technology understands everything about you but doesn't know who you are. So I find that point really interesting because in a way what I think, I would combine two insights here. One is the blockchain. So the blockchain enthusiasts really believe that in a way there is a technology that allows no central authority to control your money. Now, what I'm after, I could give away the authority to the central bank, perhaps, to control, the money. That's fine. Now, but what I'm really after is to have no central authority to control my data. So, if there was a technology, would you conceive the future in which me, as an individual, would actually can monetize my own data rather than really allow, say, the Googles and the Facebooks of this world to actually monetize my data in exchange for, letting me social network with friends and so on.
Sure. So I think there's a couple of misperceptions, and one is about blockchain. So this decentralization, I think Markus and other people already point out that there's a trade-off between the efficiency and decentralization. So actually, it's very hard to get away of the intermediaries because they're very efficient. So I think there's huge trade-off. And the blockchain, for example, a Bitcoin as a currency, it doesn't exist for us, for Alipay. So on the peak day, we actually have to process more than 300,000 transactions per second. So for us, Bitcoin doesn't exist because it only processes 3 transactions per second because it's so inefficient. Everything has to be proved it exists. So it's just very inefficient. So that's one point. So there must be some trade-off. I think you have to trust somebody. That's what I'm trying to say. The second point is that I think it's really, really fundamental that actually we are living in the information age. So the sharing of the information is the power of this age, is the new production input. So we just have to make good use of it. But in the meantime, we have to have the right privacy protections. Now that come back to your last point. You're trying to say that, okay, then I should have some kind of property of that data. We can share that. I think that surely can be explored. But it's unlike right now, you're completely explored. In fact, right now, you're using a lot of the apps for free. So it costs actually to build those apps. So actually, there's certain exchange already, but it can do better. Maybe there's some kind of monetized schemes to do that. I think that's possible. Yeah.
I'm just going to say one quick thing. In response to your presentation, but also the conversation that just came up, I really enjoyed your talk, but I do want to push back a little bit on, and I'm glad that you brought up the privacy issue. I do want to push back a little bit on the idea that technology will solve this for us and will let us have our cake and eat it too. Privacy is my main area of research. I study cryptocurrencies as a side area of interest. And just if we look historically at the other domains in which big data has been deployed, these technologies have consistently been proposed, but if we look at the record of their adoption, it's abysmal to non-existent. In the domain of web tracking, for example, all of our clicks online and searches are tracked and being put in databases, and we get targeted ads based on that. There are benefits from that, but the adoption of cryptographic technologies to protect that data, even though it's a theoretical possibility, the incentives are simply not there for the firms who are doing the data mining to deploy them. And so I think it's a little bit too facile of an answer. And I also maybe want to say that when you say big data, I hear surveillance. There are two ways to look at that. And so I think technological solutions are interesting to explore, but at the end of the day, we just have to ask ourselves a tough question of whether to get the fraud down from 0.1% to 0.001% or whatever that number was, which was very impressive, whether we're okay with the trade-off of living in a society with pervasive surveillance. I kind of see the trade-off that way, which is a little bit different from yours.
So I think firstly, the trade-off is different in different countries. In the emerging market, where service is not available, bank account is not available, so it has huge, much better, bigger marginal benefit. So I think the trade-off is going to be different in different countries. That's the first point. The second, I think, I agree that you cannot just count on that technology to solve all the problems. But what I'm trying to say is that it can alleviate a lot of the issues. It's much, much better than not having those things. And also, I also want to push back a little bit. I don't think it's not the firm's interest to protect the privacy. Look at Facebook. It can drop 20% on a single day. But you think they want this? So I think this is a market mechanism, right? And the market mechanism says that every company work for their own interests, but actually, in the end, they serve the society. So I think there's a lot of problems, challenges. I agree, but I think it's not so extreme. Yeah.
Let's go to the next question. Perhaps you first.
Just a quick comment on you were talking about. You cannot assume that the inefficiencies in crypto will be there forever. That technology is improving and will improve and may match whatever Visa and MasterCard are doing. A second, trust in the central bank is not normal. I'm from Venezuela, so there is no trust in the central bank there. So that may change. And I see your point that always an intermediary will be necessary, but it may come from other places with those scenarios that's happening here won't be the norm, are not being the norm. So that's what I think where things may change a little.
So Jean-Pierre, what's to say from the previous question?
No, it's a question to Arvind. Arvind.
Okay, is it connected to this?
No.
Okay, then let's combine it. Sure. Okay, let's combine it with the next question.
What is the difference between central bank digital currency and 100% deposit insurance?
So should we first answer? Who wants to jump in for Arvind?
Well, I'll jump in quickly while these guys think about what to say. But the statement that the present inefficiencies are likely to dissipate in the future with technological developments, I think that's correct. But I think the correct statement is to say, ceteris paribus, if a centralized database is always going to be more efficient. It has to be. I mean, achieving consensus has to be more costly. The more participants are involved in the consensus. Now, it might be that cost might shrink in a way that makes it very economical, but it's still got to be less efficient than the corresponding central database. That's one. That's my take on that. The difference between central bank digital currency and 100% reserves, very close, very close. Essentially, that's a property of deposits with the central bank. Narrow banking system as well. It's kind of something very similar. But essentially, who controls the fees? I mean, you saw the spread, 600 basis point spread that the banks are presently charging. I mean, you know, there are other ways to deliver the services I'm thinking. It's not, central bank digital currency isn't the unique way.
So Jean-Pierre would like to ask a question to Arvind.
Yeah, it's a detailed question. You mentioned Lightning, and Lightning is often mentioned as by the defender of cryptocurrencies as a solution. So could you elaborate on that? And I'm a little bit personally skeptical to the extent that it's sort of rebuilt a two-tier system as we have in traditional banking. And if I understand well, you have to prepay the amounts of the transactions. So you're basically sort of reinventing the wheel by building a two-tier banking system and immobilizing a lot of liquidity. So that's my first question about Lightning, but it's a detailed question. And then you mentioned Ether and the fact that they're always experimenting. And there has been this talk about Ether, about the time bomb, meaning that they have ingrained into the protocol a system which raises the difficulty exponentially to a point where they will have to shift to another consensus method. And that should be happening in the middle of this year, actually, if I'm correct. And we don't hear about it anymore. And
So great questions. Let me first say that I'm not coming into this as a defender of cryptocurrencies. I've often taken the role of a critic. In my talk today, I tried to highlight some of the potential as well, but definitely not coming in, defending cryptocurrencies in general or these specific systems. But as to the Lightning Network, I totally agree with you that it is still an unproven system. Is it a reinvention of well-known concepts? I don't know. It's hard to tell. However, I think there is something to the idea that one way to deal with the inefficiencies of distributed ledgers, which I very much agree exist. One way to deal with that is to hope that technology can improve and dissipate those inefficiencies. But another way to deal with it is to treat the ledger purely as a settlement network that is only required to process a very low number of transactions per time period and to build additional layers on top of it. And I think a positive way to see this perhaps is to see the underlying distributed ledger as a way to create a technology standard for interoperability between different intermediaries who can provide services on top of that ledger. So that's one way I would see it. That's how I see Lightning perhaps fitting into that picture as well. And then you asked about Ether and experimentation. Yeah, I think that is a huge unknown as well. And I very much do see it as building the plane while flying it. And I think there is certainly a possibility that either because of a shift between different consensus protocols or because of some other major technological change in the system, something catastrophic will break and it will all go to zero. I think that's perhaps okay. I think that's one way in which cryptocurrencies compete with each other. We do have one cryptocurrency, namely Bitcoin, which takes a very, very conservative approach to technology development. And so you have one fast-moving but potentially higher risk option in Ethereum, and you have a slow-moving but perhaps more reliable option in systems like Bitcoin.
Just one more question over there. Okay.
I have a question for David. So you were talking about a non-blockchain based central bank digital currency. Assuming that cash is disappearing, and we've heard some comments on that, would you still say that it makes sense to have a non-blockchain based central bank digital currency, or rather a blockchain based mainly for privacy reasons?
That's a good question. I've speculated on that in a post I wrote on FedCoin. I don't know. I'd be myself if I had it my way. I'd let the private sector handle that. I mean, I guess one way to think about it is whether or not kind of anonymous Swiss-style bank accounts might be something that central banks could offer. There is a demand for that sort of stuff, but for a variety of reasons, KYC, know your customer, and anti-money laundering laws, I think that would make it a very difficult proposition to implement in reality. So in my thought, I've just taken it off the table and just focused on non-blockchain based, kind of account-based monetary objects working through conventional database management systems.
There's one more question. I was wondering also whether you can talk a little bit to the tokenization thing, whether you have some take on that too. And let's combine it with your question, yes.
Okay, thank you very much. So my question is probably not related to the FinTech, FinFinance. And the question is for Dr. Chen, Dr. Long. I quite appreciate the service provided by Alibaba Taobao because I'm a heavy user of Taobao. It's really efficient in terms of shopping. I just click, then the merchandise will be delivered to my home in a few days. But the problem so I encountered is that it happens that I just had too many boxes and I don't know how to deal with them. And I also often see that outside the kind of commercial building, there's a pile of boxes. I think a majority of them from Taobao. So I think the Alibaba set up some subsidiaries such as delivery company to provide a service of delivery. Do you think about how to recycling those boxes to reduce the green footage? So I just think there's too much waste of boxes that are made of paper. So because of that, because if I go shopping personally, I don't need so many boxes.
So let's combine this with the tokenization and say to what extent we still need these accounts, because we can. Does anybody of you want to? Please, all
yours. Yeah, I think logistic, of course, is the side effect of the booming e-commerce. I think a lot of Chinese they have this habit of. They order a lot of stuff nowadays. It becomes a mobile device life. But I think this, again, the solution is kind of lagging, but it's coming up. And more we are actually using the logistic, the boxes that are more and more using this that can be completely recyclable. So I think the solution becomes much cheaper, but it's not the majority yet, but I think it's we see that, and so we see that the logistic industry is making a lot of efforts to make this cleaner, greener, and I think it's in the near future we can have this very recyclable, completely recyclable the packages because it's so large scale. Actually, it becomes so much more efficient to do that. My point is that it's coming, but I appreciate your concern. I also hate that.
I really appreciate your efforts to combine questions, but my answer is going to have nothing to do with your answer. Yeah, to the question about tokenization, I think one of the really cool things about distributed ledger technology is it lowers or eliminates the barrier for anyone to issue their own token. And in the last few years, we've kind of see that go wrong a little bit with a lot of the tokens that are being issued being scams of various kinds. But I think the next 10 years will perhaps be more interesting as more regulated players enter this market and figure out what types of tokens are actually useful and valuable.
Okay. So, there's one more question, then that's the final question.
It's to Arvind, and maybe everybody can come in to answer that. So blockchain as such has a use case as a currency. It's a decentralized currency, but it also has usage as some other aspects of decentralization. It's a simple centralized versus decentralized aspect. And some of the recent innovations are initial coin offerings that's been happening. So what's your take on that? As in, do you see that as a stable use case of blockchain technology in future, like raising equity?
Who are you asking? Me?
No, so anybody can jump in.
The initial coin offerings, to be honest, I don't personally study those things in detail, but these just seem to be standard ways to raise funds through this new database management system. Yeah, I don't know. I don't know if this is good or bad, but it's definitely new.
So I'll say that it's way too early to tell. As I said in my talk as well, I think a lot of what we've seen in the first 10 years have been, interesting and cool, but hasn't really resulted in anything productive and useful. And a lot of the efforts to raise equity through initial coin offerings are things that the SEC has been cracking down on, as you might know. I would say that we have to wait and see if the next 10 years are going to bring something different. But so far, that story has been disappointing.
Okay, so I would like to thank all of you for coming and listening, and also to the panels for an excellent presentations. And I wish you a great lunch and a nice end of the meetings tomorrow.